Hey guys, welcome to another Trade Genius podcast. On Saturday, we kind of laid out a plan for what we felt the path was forward with the Fed and the banks and everything like that. Well, we've just gotten another piece of the puzzle. It's not good, so stay tuned. We're going to dig into it.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey Bob, crazy weekend, a lot of shuffling going around, UBS buys Credit Suisse, and we've been digging into this material, what's going on, this bank bailout program, and I think we've uncovered some nuggets here, but I'm going to let you explain it because you do a much better job than I do. So what's the next step in this whole thing?
Oh, that's very kind of you, Phil. I think you do an awesome job with it. But having said that, have you guys ever been to a prostate exam if you're a guy? Or that's kind of what it's going to be like to get a loan going into the future. So, and, before I even get into it, Phil, I don't even know why this shouldn't just be a normal course of events. I think it's a really elegant solution to the problem they have. It's just that it's just so herky-jerky that it just screws people up. They can't plan correctly. And what they're essentially doing is they're going to turn every bank pretty much into a zombie bank. So they first of all said, hey, look, I don't care where you bank, we're going to protect, most depositors. And there's going to be a lot of political pressure on the FDIC and the Fed to increase that limit up higher. But in lieu of that, what's going to happen is that the Fed's going to create a structure that's going to allow these banks to be able to get adequate liquidity to make sure they don't have bank runs on them in terms of, what they have in their portfolio that's not cash. And so where it leads us is that the banks are just going to simply stop lending. This has happened before, and they're going to now take all of their assets that they have basically from the liability of taking in these deposits, but they're not going to lend them out. The Fed is going to give them a better return, giving it to them. And the thing that you were telling me about, Phil, is that it looks like they're zeroing in on under 1 year and less kind of notes, which would create some positive yields for some of the instruments out there. And then the Fed actually gets to move it off their balance sheet onto the bank's balance sheet, but the banks get get paid on it, and there's no need for them to lend, and there's no lending and default risk. But what it means to you as a consumer is that there's no loans for you. It's going to be you're going to have pristine credit, and you're going to have to be over collateralized for them to give you a loan. And it's going to become a big problem, but you're not going to see that for another 3 to 6 months. But basically Jerome Powell's going to get what he wants. He's going to tighten up the financial conditions, and it's going to allow them to then pause interest rate increase, maybe even reduce them, Phil. But it's really Mox Nix. If the loans go from 6% to 2%, but you still can't qualify, they don't care. And it takes the pressure off the government because the government's going to be able to borrow at those lower rates, and the consumer now is in a tight condition. So that's my understanding of how this thing's rolling out. And you can hear they're kind of screaming at you, this is not QE, this is not QE, this is not QE. And they're right in the sense that it's not QE. It's a big shell game with who owns what assets amongst all the banks. They're shifting from large banks to small banks. Small banks people are moving their money to large banks. Depositors are moving money to the Fed. The Fed is now going to accept money market and MBS and treasuries. And so that people then can move their money out of their deposit cash account into these protected investments by the Fed, but then their lending base goes down. Does that make sense? Is that clear to you, Phil?
Yeah, no, it does. This BTFP, we're going to unpack this more as time goes on, guys, but from the Fed standpoint, it's a rather elegant solution that remedies a few problems that are going on. So like Bob said, it's going to be deflationary in the coming 3 to 6 months. And then there's going to be some interesting, let's say, collateral effects that happen that might be counterintuitive. We'll go into that in another video, but essentially, like Bob said, it's going to be hard to get a loan. Businesses aren't going to get a loan. Why they didn't do this sooner, Bob? We were talking about that, right? Was it just to get the regionals in trouble because they knew they had this hold to maturity problem and then they could be gobbled up by the big eight?
Yeah, that's what I'm thinking, Phil. So, it solves a lot of problems. If you're sitting at the government end of the table, forget morality for a second. What would you rather deal with? 2,000 regional banks or a dozen super big banks that you can have a lot more control and influence over.
Right.
Number one, and number two is that these guys like to operate from a crisis standpoint because they don't have to go through all that pesky oversight. We got to do this now. Look what happened with Credit Suisse and UBS Bank. I mean, if I was the Saudi monarchy, I would be livid right now. They basically changed the rules overnight.
Yep.
Bondholders were wiped out completely. Some equity holders got their money, Phil, which that's ass backwards. That's not how it's supposed to work.
Right.
And they just screwed these people.
Yep.
And so, like, was Saudi Arabia going to invest in banks anymore, knowing that the rules can change at a moment's notice? This is one of these things that they're doing things for convenience, but the long-term implications are dire in this environment. And so, what we're going to see here is probably a bit of a sugar high because people think, oh, everything's okay now. And then it's going to be a strangulation. I don't know if I've said it in this podcast before, but I know I say it in the room. I say it to Phil all the time. This is going to be an Alzheimer's market. It's just going to be a long goodbye. And it's just going to just frustrate people to no end that every day, oh, I'm down again. Oh, I'm down again. Oh, pop. Oh, we're good. We bottom. We're down again. We're down again. And it's going to suck. And what they're doing here, they're creating a steepening yield curve where they can keep the banks in what's called a positive environment where they can borrow short, lend long. That's what they call it. And they took duration out of the game so that the banks are going to have are totally going to be ring fenced, moat protected, guarantee levels of profit. And right now, all we really have in this country now is massive amounts of depository banks. Okay, they're not lending institutions anymore as we knew them. And here's the other thing, Phil, if I can maybe digress a little bit, but it's kind of related. I was sharing with you, I did a run on my filter. There's approximately 6,600 public companies trading on the U.S. exchanges. Can you guess what percentage or what amount of those have shown a negative cash flow in the last 12 months? 1/3 of the S&P of the global, basically the entire market is negative cash flow.
That's not good.
Do you know what that means when they have to go refinance these notes? Okay, they're going to crowd these guys out, and you know what that means? It means that when that comes up, they're going to have a couple really painful choices. One is massively dilute their shares. Okay, by going now to the equity markets and saying, give me money and I'm going to dilute my shares till I get you to pay down the debt. Number two, if they have enough collateral, they're going to be paying 7, 8, 9% versus paying the 1 to 2% like they used to pay. Or number three, and related, is that they're going to have to retrench or actually go out of business or get bought. That all has to happen yet, Phil. And I think this ties back to your 100 weeks of we got to figure this stuff out. We put a new bottom in. All that has to be cleared up. In the meantime, the federal government is sitting there. They're walking past, the Weight Watchers meeting that they have every week, and they're going to gorge on all this people desperate for yield, okay, and fixed income, and they're just going to suck it off. They have trillions of dollars, Phil, in the next year to roll. And I think that's also part of the plan. They're going to crowd out the private sector so that the public sector can just keep gorging on debt. And eventually that's going to turn into, I think, a pretty strong recession coming up.
100% agree. And there's going to be a lot to unpack. So stay tuned as we work through all of this. But this program is a little bit of a game changer. And like I said, there's going to be a lot of nuances that happen as we go down the line. And we'll talk about that in future videos. But Bob, thank you for explaining all that. Guys, thanks for watching. Please hit like and subscribe and smash that notification button and set it to all if you could. That would be very helpful. Also, we're going to do just a reminder, we're going to do our live broadcast on Wednesday. Tune in, make sure your notifications are on. Otherwise, tune in about 10 minutes before 2 p.m. Eastern, and then we'll walk through the announcement and all the madness that ensues. So look forward to that. See you guys later. Take care.
Trade Genius.